Bitcoin has crashed by about 30% over the past 2 months. Still, many investors continue to celebrate Bitcoin as the new digital gold standard. But the crash reveals something that many people don't want to see. Maybe the system is much more fragile than it appears. In this video, I'll explain why Bitcoin is structurally extremely vulnerable to major crashes, and I'll also show you historical parallels, using 4 concrete examples. Here we can see that the price of Bitcoin has crashed by nearly 30% in a very short time, from October 5th of this year until now, dropping from $126,000 to about $91,000. At one point, it was even down 35%, at around $81,000. Then it immediately shot back up by $10,000. So it's very volatile, and of course, we can also see that there have been even more extreme fluctuations in the past. For example, here we had something similar in January of this year. It dropped from $108,000 by 30% as well. But after that, it went back up by 70%. And if we look even further back, in 2021, it dropped from a high of $70,000 by an incredible 75%, down to just about $17,000. And here too, in 2018, it fell from a high of $19,000 by over 80%, down to just $3,700. So there have already been much bigger crashes in the past, but so far, new all-time highs have always been reached again afterwards. Whether that will continue to be the case in the future is something I really want to question in this video, and I'll show you exactly why. Before we get to the examples, let's first ask, why is Bitcoin structurally unstable in the first place? It's simply because with Bitcoin, you have something that doesn't actually produce anything. So it doesn't generate any cash flows or any other products that could be sold. Of course, it also doesn't generate any dividends or anything like that. You have something where, after buying it, you just hope that someone else will pay more for it at some point, and that, by definition, makes it speculation, not an investment. Because if demand drops, the value also drops rapidly. That's different with stocks, or rather with companies, because when you buy stocks, you actually own the underlying company, or at least a part of it. And the company usually generates cash flows, meaning products they sell or services they provide. And when you have this cash inflow, it can be distributed to shareholders. With that, you can also continue to expand or do similar things, and that means you have something of real value. And now we come to the first historical example, which most of you will probably still remember. After that, we'll look at 2 lesser-known examples. One of them is the tulip bubble of 1637. At that time, many people in the Netherlands bought tulips, or tulip bulbs, as a speculative investment. People thought, okay, these are very rare. And because the supply was so low, people said, okay, there's not much supply, so the high price must be justified. People drove the prices up. So what happened in the end? The price of tulip bulbs skyrocketed, here by about 60 times within 3 years. And then demand collapsed. And ultimately, just like with Bitcoin, there's no real intrinsic value behind tulip bulbs. You can't generate significant cash flows with them. So after demand dropped, the price also fell close to zero. Let's move on to the second example. Here we go to the year 1720, when there was the so-called South Sea bubble. Back then, the South Sea Company promised extremely high profits from trade with South America, and the stock price was driven up from about 100 British pounds to over 1,000 British pounds within just a few months. Then, as investors, people realized that the company wasn't actually making as much profit as promised, but much less. In other words, there wasn't really any value behind it, and that euphoria faded away. Accordingly, demand and the stock price dropped sharply, and in the end, returned to the same level as before the speculative bubble. This already shows once again, when prices run away from the fundamentals, they will eventually come back down. The next and third example, which I find especially interesting, also shows that these speculative bubbles didn't just happen over 100 years ago, but still occur repeatedly in modern times. Now, let's take a quick trip back to the 1990s, when these little balls here were extremely popular. They were called Beanie Babies and cost about $5, and the manufacturer of these little balls deliberately limited the supply, always producing only limited editions. And because the supply was restricted, people once again thought, Well, there aren't many available. That means, in this case, you could easily justify much higher prices. People started collecting them and reselling them at high prices because everyone was collecting them at home, which meant there were fewer and fewer available on the market. The prices shot up from $5 to over $500, and in some cases even over $1,000 per Beanie Baby. And when demand eventually dropped off again, prices crashed dramatically and ended up back around $5. So those who had bought them as speculative investments at several $100s lost most of their money. And this shows once again, this is always the argument of Bitcoin supporters, that Bitcoins are limited, and that's why a higher price is justified. But there are so many products or other things that are also limited. And just because something's limited doesn't automatically mean that a particularly high value is justified. Because if there is no more demand, then it doesn't matter whether there are 1 million of these balls or Bitcoins or 10 or 100 million or even an infinite number. If there is simply no more demand, then there won't be any buyers willing to pay exorbitantly high prices either. And the fourth example, most of you probably know this one too, is the NASDAQ. Here we can see that the price was driven up within just a few years, from 1990 to 2000, from less than 500 points to over 5,000 points. And when the hype around these internet stocks was over, the price crashed back down to just over 1,000 points. So here too, roughly a 90% loss in value within 2 years. And some individual stocks were even more extreme. Here we have, for example, Pets.com, a company that in the year 2000 was still trading at $11 per share, but actually didn't generate any significant revenue or profits. It just jumped on the internet hype bandwagon, and a lot of people ended up buying this company as well. It had a .com at the end, so it had something to do with the internet, and for many investors, that alone made it instantly valuable. They thought that this high price was justified, but what happened? After demand dropped off, that is, after the hype died down, the true value of the company was revealed, and the company was valued accordingly. And the stock price fell from those $11 to just 13 cents within a few months. As a result, investors lost almost 100% of their money. So what do these examples mean? Well, if there's no intrinsic value, then the risk of a major crash is very high. But that doesn't mean this crash will happen next week. Sometimes it can take months, sometimes years, and sometimes maybe even a decade or two. But it's very hard to predict when this crash will happen, and that's why the risk is so high here. So why are stocks much better protected in comparison? Let's just take Apple as an example here. We can see that Apple made about $100 billion in profit last year. That means if the stock price were to drop close to zero, as a potential investor, I'd buy up all the shares because they'd cost almost nothing, and then I'd own the company, in this case Apple, and every year I'd get the entire profit of over $100 billion. That's why the stock price would never fall that low, because other investors see the same thing. They see that those high profits would then belong to them, and that keeps the stock price up. Of course, stocks can crash dramatically and even go to zero if the underlying company is worthless or if the company was previously way overpriced. For example, I wouldn't buy Apple right now because it's way too expensive for me. There's also significant downside potential here if we ever have a bigger crisis and people start fleeing the market. But there are other stocks that I currently find much more interesting. And if you're interested in those kinds of stocks, feel free to subscribe to my channel, turn on notifications, and you won't miss any of my videos where I often look at undervalued stocks. Of course, the hype around Bitcoin could continue. That could go on for another 10 years. The price could even rise to over $1 million and beyond. But it's almost impossible to predict that exactly. And if a major economic crisis hits, or if Bitcoin's popularity drops significantly, you could end up in a downward spiral here. Such downward spirals usually start with a few people selling first. That causes the price to drop a bit. Then people slowly start to get scared because the price is falling and more nervous holders sell. That makes the price drop even further, and the whole thing ends up in a downward spiral until eventually there's panic in the market, everyone just wants to sell, there are way too few buyers, and the price crashes significantly as a result. And compared to stocks, as just mentioned, there's no stabilization here from any intrinsic fundamental value. So in the worst case, the price could even go all the way down to zero. That means Bitcoin and other cryptocurrencies are, of course, highly speculative, and every investor should think carefully before buying and weigh cryptocurrencies accordingly in their portfolio. Personally, I don't own any cryptocurrencies, and if I were to buy some, I would only invest a very small portion of my portfolio in cryptocurrencies so that I could still sleep well and live comfortably even if their value dropped to zero. As a value investor, I always look at both the opportunities and the risks, and I want to make sure the risks don't get too high. And if you not only want to learn something about cryptocurrencies, but maybe also about dividends, like why dividends aren't always positive for investors, then feel free to check out this video next. Enjoy, and see you next time on German Value Investor.